and welcome to a new ATFX video. My name is Gonzalo Canete and I'm here to share with you a quick review of the week. We're gonna take a look on equity markets, fixed income, commodities. We're also gonna take a look on Forex and finally on cryptos. We are gonna mention and review every single important corporative and macroeconomic event happened this week. We got certain numbers from the United States. I have been, just a reminder, okay, I have been posting you every single day the quick update on the market, which is the blog of our ATFX Connect blog on the section of market snacks. So you go to atfxconnect.com, you go to the section market snacks, and you can find the report. This is the one I published today. You can find any one of them for every single morning, every single day, which you can go into details to analyze absolutely everything. Not only the last macroeconomic data published yesterday, today in the evening. If you're watching this video, you're probably watching this video by the beginning of the next week, because this is the recap of what happens, the important factors happens this week. Let's start with the last things, like the things that happens during this evening, last few minutes ago, during the American season and Wall Street season, let's say, and the market. So we got the witching hour just with the expiration of the derivative contracts on futures and on options, which usually generate volatility. And I believe we are right now in that moment. We're probably gonna see the next few hours that volatility. Mainly what happens during these hours is like the old contracts expire, and then the new contracts, the new futures, and the new options start to be negotiated, be in place in the market. And there is certain gaps during those rollovers, the ones who close the contracts before the ending, the maturity of the contract, and the ones who open new positions in those new contracts. But the question is if those new contracts coming up or above the price of the closing price of the previous contract or below, which is called contango or backwardation. It usually also an indication of the market, like a bullish or bearish market in advance. So very interesting from that point. Overall, SP 500 is still strong, but dropping for the last 2 days. I will say that the main cause of this drop in the SP 500 probably is caused by the numbers published yesterday. Let's go to the calendar. Yesterday, United States was published the what is called retail sales mainly, and also PPI, production prices index, which is the kind of one of the components to measure the inflation, PCE. And the point in here is that those PPI was slightly higher than expected. So the expectation was 0.3 and it was actually double. It was 0.6 monthly. And also if you check the retail sales, it was expecting a monthly 0.5% on retail sales, an increase of 0.5%. It was actually 0.3%. I believe the movement of the market since then is more caused by the PPI more than anything else, because the PPI has a component of the PCE of the inflation. The PCE is the favorite inflation measured by the Federal Reserve, which means we recently have seen the general inflation data, IPC, and it was published by CPI, Consumer Price Index. It was published a few days ago, and it was actually indicating a slight increase on that inflation measurement, which is a kind of signal that could make us think that the Federal Reserve cannot cut the interest rates if the inflation is rising. However, there was no effects on the market. That numbers didn't pull down the market. On the contrapart of what happens on January. In January, actually, those numbers, which was actually again was higher than expected, they pulled the market down. But in this case, let's go to the inflation rate from the previous periods, and you will see exactly what I mean. During the previous periods, we didn't see the market dropping. In this case, in January, the inflation was causing actually a drop in the market. But in this case, February inflation didn't cause any retracements on the market, or not so far. But now, This week, with the PPI index higher than expected, this is probably one of the reasons why the why the market was twisting and start to fall. The reason is, again, because if these numbers are right, if these numbers are correct, and they are increasing from 0.3 expected to 0.6%, it means like eventually maybe we're gonna see a higher inflation in the coming period and the next PCE, and in that case, Federal Reserve probably gonna get forced to make a pause or don't even cut the interest rates. It's something we mentioned also on Monday report on our blog. One of the things we were mentioned this Monday was actually one of the opinions, one of the positions of a top analyst in United States, which he was suggesting actually that maybe this year, 2024, Federal Reserve is not gonna cut any interest rates. Why? Because the inflation rate gonna actually rise. Technically speaking, we can see that certain factors, pro-inflation factors like oil, are rising, as you can see here. One of the reasons why the price is getting apparently more is getting stronger and responding positively to the market is that we published this week. I was mentioned also in the report this week, early this week, the expectations of demand done by the OPEC Plus, so the countries who produce oil and gas. The expectation of demand, they mainly give a higher expectation of demand than the International Agency of Energy, which means like it's they reviewing positively the demand, global demand of oil. One of the main concerns for oil market, it was, we mentioned in these reports in advance. We mentioned previously in these reports that actually one of the reasons that could make the oil market falls, like it was falling for the last couple of months, it was potentially a global recession and a decrease on the global demand. Still, with the numbers introduced by the producers this week on the report, we could understand that based on those numbers, if those numbers are true and they are confirmed by the market lately, we will see that actually if it's a higher demand than expected, then the price gonna be back to mainly levels like it was breaking up 83, now it's breaking up $85 per barrel, and probably the last target for for Brent is $88, similar levels to for West Texas. Dollar index is responding really well, as you can see. It's moving upward, and it's also a natural response of these expectations that the interest rates actually could not get cut because the inflation is rising. So if the inflation numbers, PPI, are moving forward and the inflation numbers are higher than expected, then the dollar gonna get stronger. Why? Because the dollar was discounted by these numbers. This drop here, it was actually unemployment rate. The unemployment rate was higher than expected. By the way, jobless claims yesterday was actually stronger than expected too, which means like a weaker labor market was pulling the value of the dollar down because it was discounted an interest rate cut decision early. But because one of the main reasons the Federal Reserve needs, or excuses the Fed needs to cut interest rates, is a weaker labor market. One of the main reasons, mainly because inflation is composed, but one of the variables that is pushing the inflation up is services, and services is using high intensity in labor, and therefore, unless unemployment rate is rising, there is no reason to believe that inflation is going to decrease below 3% if still the job market is still strong. That was the numbers by unemployment rate rising to 3.7%. It was positive for the market. It was negative for the value of the dollar. The value of the dollar was dropping. The market was rising. The SP 500 was rising. And everyone was happy because they were just assuming that Federal Reserve was about to cut interest rates sooner. Now, because of these last numbers, PPI, the suspicions on the new higher inflation rate, is why the dollar is responding and rising, I believe. And in that case, not only the dollar, you can also analyze this by another market too, which is the 2 years Treasury bond in United States. Take a look, it's rising, and rising. This movement is also caused by the expectations of a delay on the interest rate cuts. So all of this movement, the first one and the second one was caused. First one because of the bad results on the labor market in November. The second drop, it was caused by Jerome Powell mentioned the interest rate cuts on the bonds. And now, after all, we can see here that by the end of February was breaking up again about the levels of 4.45, 4.50% on the yield. And now when it was dropping back again, the labor market was giving bad results again, and it was dropping the yield. After what happens now, we can see that the yield is rising back again. Now, if the yield is rising, it means that the interest rates are high. They are not gonna cut interest rates. If the yield will drop in below 450, is discounting that actually the yield is dropping because the interest rate's gonna drop as well, because they are correlated positively. So that is what we are analyzing right now, and this is what we are following. The actual move of the treasury bonds, particularly the 2 years treasury bond. I hope you find this useful. What else we can mention? Adobe was presenting results yesterday and it's dropping 14.25% on the market. Overall, the evolution of the company was good. Nothing really bad. I took some notes. I don't know where I left the notes here. Oh yeah, it's here. One of the main companies, the market capitalization is high. Everyone knows the software, mainly focused on creativity, digital designs, and so on. But for some reason, it's dropping strongly. From a fundamental perspective, we know that the company is not given one of the best or more attractive EPS share price, EPS price ratio. Mainly just the dividends are small compared with the value of the price of the share, better say. And because of these reasons, is because we believe that the company is not rising as expected, because the competitors are massive. There is a lot of companies now in the text industry that are competing with this one, with Adobe, and therefore there is many reasons why you could just find another options if you want to invest in this sector. Still, some traders are suggesting buy now during this massive drop because they can buy in certain support levels Adobe. But as you can see on the chart, long-term chart, if you go back to 2021, I will say the supports are not still there. We could even wait between $450 to $435 per share, and it's not still there. So therefore, you can expect that this company keep dropping the coming days, most likely. Okay, so be careful. And in any case, this company is not inviting us to invest in them. All right, I think that's all. Again, you want to go into details, please go to our daily market snacks, because you can find all details of every single day here. And you can just see, for example, one very interesting market we have been mentioned from a fundamental perspective, but also from certain levels, is the dollar Japanese yen. We have been explaining here that yesterday, in the report that we published yesterday on Thursday, we were mentioned that Toyota, one of the biggest companies in Japan, was making a new wave negotiations, and they were increasing the rent by 25% of the workers, and therefore if the sector, the rest of the industries in Japan are following this trend, they're probably going to increase the wage, and therefore the main concern of Bank of Japan is an increase on inflation via the salaries, and that's why they want to probably consider now more serious than ever, consider this historical increase of salaries in Japan, probably move forward with the change on the monetary policy and increase the interest rates. Keep in mind that all the rest of the central bankers in the world, Federal Reserve, Central Bank of Europe, Bank of England, and even Popular Bank of China are considering cut interest rates to make more stimulus in the economy. Europe is in recession, China is in a slowdown, and United States is apparently what they call soft landing. Everything is fine, we're just waiting that the market, the economy calm down. So in this case, Japan is the only country in the world that is considering to increase interest rates. Since 2007, they never increased interest rates, and since 2016, they are keeping that policy of interest rates equal to zero or negative real interest rates. So So this is a massive change, and especially it's important if you go to the pair dollar-yen and you take a look and you see that actually we are facing one of the top maximums ever in Japanese yen, which is, this is the thing, this is the fact that we can expect, right? If finally the Bank of Japan increase interest rate, we can expect a 180 degrees twist on the market. But we are so close to 160 yens per dollar. 160 is the maximum top record registry for the last almost 40 years, 34 years, since April 1990. And therefore, I believe one of the most attractive trades could be something in this area. Still, I'm not telling you what to do with your money. This is not advice of any kind. This is just a market report, and I'm just sharing information here. Anyways, if you enjoy these reports, I invite you to keep following my daily macro update on ATFX Connect. You also can join us on the newsletter. Let me share with you my personal contact. So, let me check. This is not the one I'm looking for. Here it is. You can find my email there. So if you want to join the newsletter, it's completely free. You just need to contact me through the email, request, please Gonzalo, add me to your newsletter, and I'm gonna send to you not only the report that you can find in ATFX Connect blog, but also on your email you will get that report, and plus also in our social network, because I'm also posting here an hyperlink on ATFX Connect on X to our blog directly. Okay, take care and enjoy the market, because it's getting super interesting, and my vision, my feeling is the market gonna twist back sooner or later. Okay, bye bye.